Welcome, everyone. My name is Marc-Andre. I am the director of the Canadian Centre for the Study of Co-operatives. We're very grateful for you joining us today to learn about Abdullah Mamun's research into the impact of mergers among Canadian credit unions. This is some of the first kind of work of this kind that we know of in Canada, so this is very exciting. Please note this event will be recorded. You might have just gotten a notice about this a moment ago. And then it's going to be published on our YouTube channel. If you prefer not to be included in the recording, you can turn off your camera, change your name on Zoom to remain anonymous. So that's your option to kind of stay out of the picture if you like. If you're interested in attending other Canadian Centre for the Study of Cooperatives events, please email us at coop.studies@usas.ca to get on our mailing list. Stan will post this email address in our chat function. So you can just kind of click on it from there. Now, to help our event run smoothly, we're going to ask that all attendees stay muted and turn off their videos during the presentation portion of our event. But then feel free to turn your video back on for the Q&A. The format for today's event is going to be about as follows. So Mamun's going to present for about 20-30 minutes, maybe a little more. After the presentation, we're going to open things up for questions. And if you'd like to ask a question, either raise your hand using the raised hand function in Zoom, or just signal us in chat. Write your question out in chat, and I'll read out your question for Mamun. And I should note, questions can be sent to me at any time during the presentation, but please kind of hold that hand raising function for after the talk is done, or after Mamun's presentation is done. If you have any logistical questions, please don't hesitate to send a message to Stan Yu, who's kind of staffing the kind of technology part of today's event. Using the chat function. So that's Stan Yu. He'll help you with any logistical matters. Now, before we begin today's conversation, I'd like to start with an acknowledgement. The thing I want to acknowledge is that, of course, we're coming to you today from Treaty 6 territory in the homeland of the Métis. Now, in making that acknowledgement, I think it's also important to stress that the wealth that's been generated from this land, from the abundance of this land, has not been shared equitably with its original inhabitants, the First Nations and Métis. And cooperatives and credit unions are as culpable as any of us in that process. So I think this is something to acknowledge, and it's something that, if you look at the history, is pretty clear. So I think this is important in light of what we've learned about Kamloops, but in general as well, that we make amends and acknowledge these facts. With that, I'd like to introduce our speaker today. Dr. Abdullah Mamun is an associate professor and graduate chair in finance at the Edwards School of Business here at the University of Saskatchewan. And I'm proud to say also a research fellow at the Canadian Centre for the Study of Cooperatives. Dr. Mamun has been involved in teaching and research on financial institutions for more than a decade, and his current projects really revolve around financial economics, risk management, earnings management, and mergers and acquisitions amongst banks and credit unions. I should also add he's a wonderful colleague, and I'm very fortunate to have him just down the hall, or not down the hall, but across the way when we're on campus. So with that, welcome Mamun, and welcome to all of you. Mamun, please begin your talk.
Thank you, everyone. Thank you, everyone, for coming to my presentation today. Special thanks to Marc-Andre for making this happen, to Stan for the logistical support. And thanks to both Marc-Andre and Jordan from CUNA for some of the data support and data insight that I needed to make this study happen. Marc-Andre has given me a flattering introduction. I don't think I'm going to talk about myself anymore. So let's get into today's presentation. So today, my topic of research that I would like to share with you about is growth, the growth of credit unions. Okay. Why do we need growth? Why does credit union need growth? The growth gives credit union, just like any other institution, a competitive edge. It helps it to retain its customers who are growing, whether it's a business customer or an individual, by providing them with the support and the services that they need. It also helps the credit unions to allocate resources appropriately so that they can grow and be relevant as the need arises. I'm pretty sure a lot of you are industry veterans who can probably list another dozen reasons why growth is important, but that's not the story I would like to tell today. My story is to look into growth a bit more carefully. And at least I'm convinced that by looking into growth, I'll be able to explain some of the other things that are happening in the Canadian credit union industry, which some of which are also common in the US industry. For example, I think I'll be able to relate growth or the lack of growth to the federal charter, the larger credit unions going after federal charter. And I'll also be able to explain why we are seeing massive merger, which to me at least looks like a huge merger wave that's happening. Okay, with that introduction, let's look into the growth of the Canadian credit unions. So over the decade, so starting from 2008 to 2019, the credit unions in my data set have posted an average of 6.9% growth, that's in asset growth year over year. To me, this is pretty impressive. Let me put this into some context right now, but I'm going to give you a bit more context later on. So when I went into CCUS website to get the growth estimates system-wide, I could only get my hands on 2015 to 2020 data. And according to that data, the system, the credit union system in Canada grew about 6.73% between 2015 and 2020. With the help of Jordan, according to CUNA's calculation, the US credit union industry during the same period have grown about 6.10%. So it's fair to say the Canadian credit union industry has grown at least at par with its own siblings, the smaller credit unions within the system and with other credit unions in North America. So the question that I'm asking is, what determines this growth? To me, the answer to this question has implication for both credit unions and also for the policymakers and regulators. So why do we need a Canadian study? I have listed 4 reasons why I think a Canadian study is needed. Okay, there are lots of US studies. Some of them are quite recent. And then there are European studies, and there are studies in Australia and New Zealand, but we don't have a single study that looks into Canadian credit union industry's growth. We simply cannot borrow the findings from the US or other studies and sort of replicate and sort of make a general conclusion about the determinants of growth of Canadian credit unions. Here are my reasons why it's not possible. Number one, there is substantial difference in regulatory framework between the Canadian credit unions and credit union industry elsewhere. For example, in US, almost most of the credit unions are regulated federally. In Canada, almost all the credit unions are regulated by provincial regulators. There is a difference in deposit insurance scheme. For example, in US, the NCUA insures each credit union or each depositor up to $250,000. In Canada, there's a huge variation in deposit insurance. For example, in prairies, in Saskatchewan and Alberta, this deposit insurance is unlimited. Okay. In Atlantic provinces, New Brunswick, Newfoundland, and Labrador, and Nova Scotia, this coverage is up to $250,000. Other than Prince Edward Island, which has a deposit insurance coverage of $125,000. Okay. So across jurisdictions, the deposit insurance is very different. Third, the competition the credit unions faces in Canada is very different from the competition credit union faces elsewhere. For example, in US, the credit union faces competition from multinational banks, large national banks, and small community banks. In Canada, the banking industry is oligopolistic. There are five large banks which controls about 95% of the entire banking system asset. Fourth, the concentration and the competition within the credit union industry is also quite different in Canada. For example, at the end of 2019, according to NCUA, there are about 5,000 credit unions in these states, whereas in Canada, at the end of 2019, there are only 251 credit unions outside the province of Quebec. Okay, so all this makes a Canadian study of credit union growth that much more important. So let's look at the data. To start, Canadian credit unions are very important component of the financial services industry, probably one of the most important one when we compare across the globe. Almost 1 in every 3 Canadians access their financial services need through a credit union, which is probably one of the highest, if not the highest in the world. 2, my data set covers 100 largest credit unions in Canada between 2007 and 2019. To give you a context, these 100 credit unions outside the province of Quebec controls about 93% of the system's asset at the end of 2019. One more thing about my data is very important to know. During my study period, the credit unions which are included in my data set were involved in 75 merger events. Now, there are 2 things that are important. One is the event. Because I have annual data, if a credit union has been involved in a merger or in an amalgamation, let's say 5 of them in a given year, I can only consider it as a single event. I cannot distinguish between the effects of 5 different mergers. Okay. There are scenarios where a credit union is involved in merger or amalgamation, multiple of them in a given year. In an extreme case, in 2018, there was one Cassie Popularis which was involved in 13 different, involved in amalgamation which involved 13 other Cassie Popularis. Okay. So when it came to the sources of growth, I looked at 7 different components. So in addition to the merger as a source of growth, I looked into size. So essentially, I looked at economics of scope. I looked into the diversification of product. I looked into the efficiency, looked into capitalization, looked into risk, generally credit risk, and finally, the loan portfolio composition. So here are my results. And for the sake of the general audience, I am not going to present any of the technical details. It's mainly the results I'm going to present. So the relationship between size and growth. I find that size and growth are positively related. So as the credit unions increase in size, the growth increases. However, as the size increases, the growth rate decreases. So the growth is increasing with size, but at a decreasing rate. So essentially what I'm saying is I'm finding evidence of these economics of scale in growth. Okay. I also find that the growth is persistent. So if a credit union has grown in past, it will continue to grow in future. But what in economics or statistics, what we call the persistence parameter is less than 1, which means that if it grows by a certain percentage in past year, generally in future, the growth rate is going to be lower. Economics of scope. So here I have used 3 different measures. The first one is loan to asset ratio, deposit to loan ratio, and the fee income ratio. Now, the first 2 ratios are measuring whether the credit union is traditional or not. A traditional credit union, or which main business is basically lending, will have higher proportion of the asset in the form of loan. They will service most of their loans using their core deposit. Whereas a non-traditional credit union, which have started exploring more sources of income, we will see a higher proportion of fee income or non-interest income. So once I looked into all these 3 ratios, I found that loan to asset ratio and deposit to loan ratio really do not have any effect on growth. However, I find that non-interest income or fee-based income is enhancing growth. Now, there may be a relationship between size and the fee-based income, because there is all this literature which tells us that in order to offer additional service, especially fee-based or non-interest income services, you really need to have a certain amount of size. So there may be a size channel through which the non-interest income is affecting growth. I find that credit unions with higher cost efficiency grew faster. When I looked into the capital ratio, I found that larger credit unions, in fact, grew at a slower pace. This piece of result was not really clear or did not make sense to me to start. As I thought about it, I thought that if you take 2 different credit unions of similar size and one has a higher capital ratio than the other, what it is really telling us that one of the 2 things is happening. Maybe there is a third option as well. But to me, the first one is that the one which has a higher capital ratio probably lacks the growth opportunity. Okay, that's why they are sitting on more unused capital. So they cannot pump out more loans given the amount of capital they have. The second one, which is mentioned in the literature, that the credit unions which is sitting on higher capital ratio probably is cautious towards their growth. Okay. I also looked at risk-based capital ratio, but the data, the rules of implementing risk-based capital ratio for Canadian credit unions is quite new. As a result, the result that I get, A, is insignificant, but even if it were significant, it probably would not give us a long-term prediction on the relationship. I could not find any effect of risk on the growth. So I measured risk, mainly credit risk, using 3 different proxies. One is allowance for loan loss. The second one is provision for loan loss. And the third one is non-performing loan. Okay. And none of them had any effect on growth. Finally, and this was a bit surprising to me, I also didn't find that loan portfolio composition has any effect on growth. Okay, so other than merger, effect of merger on growth, I basically have covered everything. Now let's look into the merger. During my study period, 150 credit unions disappeared, and mainly because of either merger or amalgamation. Okay, and this number is very important because in 2000, at the end of 2008, outside Quebec, there were 516 credit unions. By the end of 2019, there are only 251 left. So most of these credit union disappears either due to amalgamation or due to merger. So at least in Canadian case, merger is something that we should look into seriously as to how it is impacting growth. Luis Dupico and Wilcox, they have two studies, and they suggest that one of the reason or primary reason for merger is to reduce non-interest expenses. Luis is here today. Probably he can give me a bit more on that. Marc-Andre, in a very recent policy note that he has written for the Canadian Center for the Study of Co-operatives, suggests that merger is a way to help smaller credit unions to exit the business. Now, when I plotted the merger and the growth, I found something interesting. So if you look at this graph, these bars are telling us the number of mergers that are happening in a given year. And these are merger events, not actual mergers, okay? And these two lines, the lightly shaded line is the loan growth, and the deeply shaded line is the asset growth. If you look at this, it almost looks like following the higher concentration of merger in a given year or given subsequent given years, there is an increase in the growth. Does not matter whether you look at the loan growth or you look at the asset growth. So there is a relationship between the merger and the growth. At least that's what simple plot of the data tells me. So what I did was, in the same set of empirical framework, which is a regression-based framework, I looked into whether merger is affecting growth. Okay, if the credit union was involved in a merger or amalgamation in past year, did it affect the growth in the subsequent year? Or if the credit union was involved in a merger up to 3 years in past, whether it has affected the growth in current year? And answer to both of my questions was, I did not find any effect of merger on growth. Now that started me thinking as to how I can look at this problem a bit more cleanly. And I borrowed a methodology that I use in some other studies. And what I did, I can probably explain this a bit clearly using this graph. So what I did, I matched each of the credit unions which acquired to a credit union that did not acquire. I had two criteria. One, they have to be of similar size or as close in size as possible, and they have to have similar growth the year before the merger. So I am looking at end of the year T-1, where I have looked at their growth rate and their size and matched two of them. Then the merger takes place between year T-1, end of year T-1, and the end of year T. Then what I do is I look at the growth between year T and T+1. I also look at the growth year T and year T+2. Okay, so I looked at 1 year growth after the merger and 2 year growth after the merger. Okay, and I looked at them in pair. This is what I find. I find that the credit unions which are involved in merger did not outperform or outgrew the credit unions that did not get into a merger or amalgamation 1 year after the merger. However, when I look at the growth for over 2 years after the merger, I find that the credit unions which merged or amalgamated or acquired outperformed when we calculate growth over 2 year period. Okay, to me, this makes perfectly good sense coming from a background of doing multiple merger studies. Generally, 1 year after the merger, still are trying to streamline the two businesses or the three businesses, or if there is a merger or amalgamation with, let's say, 13 different credit unions, you're still trying to figure out how all the moving parts are going to move together. Okay, so not finding any result, calculating growth over 1 year is not disappointing, but finding growth over 2-year period after the merger is what probably I was looking for. If I had the luxury with the data, because my data is quite limited, I would have gone and looked into 3 years after the merger. So the next question that I asked is, okay, fine. So the merger is affecting growth, but how? Is it affecting growth directly, or is there any other channel through which the merger is affecting growth? And this is where I find the most interesting result. So what I did was I looked at how the growth is getting affected by multiplying the merger with every single variable that I have considered, including the merger by itself. When I look at merger by itself, it does not affect growth at all. The merger is only affecting growth through the square term of the size. So essentially what it is doing is essentially it is reducing that disease or sort of mitigating the diseconomies of scale that I found or reported at the beginning of this study. So what I was also expecting that the merger would affect the growth through the non-interest income channel as well, or the fee income channel, but that is not necessarily the case, at least not in my data set. So that pretty much concludes as to what my findings are. So here are two policy implications of this study. First one is that the credit unions in my sample are facing diseconomies of scale. Since we have looked into only the largest credit unions, this suggests that the gain to scale probably have been fully utilized within the provincial market. This explains why the largest credit unions in Canada have already gone for a federal charter or seeking federal charter or in the process of seeking a federal charter. Second, for the credit unions for whom the marginal benefit of a federal charter does not outweigh the cost that's associated with additional scrutiny into their balance sheet and all the associated cost of going into the larger arena, but still need an avenue to grow or still seek to grow, are using merger as an avenue for growth. This probably explains why we are seeing massive consolidation within the industry. Here are my two probably final thoughts. Product diversification. I think there is a merit that the provincial regulators and credit unions within the province, whether it's large or small, should work together so that they can explore ways how additional sources of income or non-interest income can be offered through different size credit unions, okay, and relatively easily. Second, geographical diversification. The provincial regulators among themselves probably have to figure out a way for the credit unions which cannot justify a federal charter because of additional burden of regulation can still get engaged in cross-border or across the province merger and the regulators, two regulators which are regulating these two different provinces somehow can allow that, because that helps the credit unions to get the geographical diversification and not be subject to the higher standard in federal regulation, and maybe not losing the higher deposit insurance that they can offer to their clients. Okay, I think I'm doing good on time. So I'm going to show you three additional slides to give you the context of growth of the Canadian credit unions. So the first one is a comparison of growth between the Canadian banks and the Canadian credit unions. So when in blue, you have the Canadian banks, and in red, you have the Canadian credit unions. When I did my average stat, it appears that the Canadian banks are growing at a faster rate, not by very much, than the Canadian credit unions over the decade that I looked into. This is the, let me see whether I can do this. So here. So this is the crisis period, 2008, 2009. So the Canadian banks took a hit, but the credit unions did pretty well. So that's the growth comparison between the Canadian banks and credit unions. When we looked at similar sized credit unions between the across the border, the blue ones are the US credit unions and the red ones are the Canadian credit unions. It almost appears that on a year-by-year basis, generally the credit unions in Canada have done better compared to a similar sized peers in the States. But when we looked at the largest 100 credit unions across the border, following the crisis, the US credit unions underperformed the Canadian credit unions, but I think they have caught up. And now the US credit unions are doing better in terms of growth compared to the Canadian credit unions. Okay, I'm going to finish my presentation here. I am almost on time. The one thing that I'm going to finish this discussion with is working with Canadian data had been a challenge for me, because there aren't that much been done with Canadian data. It's not readily accessible. So there aren't a lot of people who can tell me the nuts and bolts of the data. We don't have any funding working on this data. So the graduate students are also not quite interested working on this data. So yeah, this has been quite a journey for me. Thank you.
Thank you so much, Mamun. Really interesting. I'm sure we have questions. Before I turn it to the audience for questions, and please use your chat function to write your question, or use the raise hand function, and I'll call on you. But just two comments. One to kind of underline what Mamun just said. The work that Mamun has shared with you today is based on data that we've purchased, the center and Mamun purchased jointly from Bob Leschetjen, who goes out and types in these data from annual reports and painstakingly gathers these. Now, the unfortunate thing is regulators, and in some cases, centrals have these data, but there's a reluctance to share it, as you probably are aware. And that makes it very difficult for outside researchers to kind of do the kind of work that Mamun's doing here. So that's one of our pleas to the sector too. Would be really nice if we had better data. Of course, in the United States, everything is available at the push of a button. National Credit Union Administration has a vast, open, public database that you can pull data from and tell interesting stories. So that's just by way of a comment. Mamun, I might ask a general question, and then I'm encouraging people to use the chat function and raise your hand. You know, I think it could be, go ahead.
One thing, I think I'm going to stop sharing my screen, mainly because if I don't stop that, I cannot see any of the chat.
Oh, fair enough. I'll monitor the chat though, Mamun. You don't have to worry about that, but you should probably take it down. It's a good idea. So Mamun, just one thing that's maybe a little confusing to people. You have these kind of findings that seem to kind of run into each other. You have that kind of matched analysis where you match a merger credit unions to a kind of unmerged credit union, and you watch the growth trajectory over time. And then you have the kind of more conventional analysis before then, and they seem to show different outcomes. Can you explain or reconcile that for people who are listening? How do you make sense of what looks like, at least from the outside, there's two different findings? So how do you make sense around the benefits of scale and mergers?
Okay, so the analysis that followed matching is generally a methodology that is now getting quite established in almost all merger studies, because the entities, the credit unions, the banks that needs to merge probably are very different in their character compared to the entire population. So if I start comparing a credit union to the entire population, which do not need to merge or do not have requirement for growing, the result may be biased. Okay. The other thing that this methodology helps, and this is getting a bit more technical, that it helps me to escape the functional form misspecification that we have, that we get by doing regression-based analysis. Okay, so the simple stat, I can say that given this is what I find, and I am not biasing my result by specifying my equation. So that is the advantage. Could I have done this from the get-go and the entire analysis that way? Yes, I could have. Marc-Andre, you are mute.
Thank you. We have a question here from Miranda. She says, "Hi, Abdullah, great presentation. I'm wondering if you can share us with us using the second methodology, that matching approach. How much did the merged credit union grow compared to a similar size or that matched credit union? What was the differential in growth rates there?"
I do not have the data or the stat ready right now that I can share, but that is available. Oh, hold on, maybe not. Give me a second.
I know it was statistically significant. I think was your finding correct, Mamun?
Yes, it is statistically significant. As to whether that difference is economically significant, that's a different question. I have not looked into that quite carefully. But this is the other thing. One of the issues that I'm running into when I'm doing the match sample is my sample size shrinks very quickly. Okay, so that is one of the things I was trying to avoid, and trying to show that the result that I am getting from using all the data is consistent when I'm doing the matched sample study. So sort of validate my results.
So Mamun, if we can always share that finding afterwards with participants, anyone who wants to, that growth rate, that differential growth rate, if you want to track it down after the presentation.
Yes, for sure.
Rather than get you too distracted right now. Do folks have any other questions that they'd like to try on Mamun? Otherwise, I'll keep going, but I'd like to involve the audience here. Oh yeah, Miranda writes, "Are you publishing a paper on this?" Yes, we are.
Yes.
We just need to do a little bit of editing, but I think we'll be getting that out soon. Excellent, you're welcome. Any other questions or comments? Mamun, maybe I'll throw one out here. If you're in the credit union sector, I mean, you might be saying to yourself, well, this is kind of an historical perspective looking back at data we have. It's not looking forward. If we're looking forward, as a credit union, you're staring down a whole bunch of costs, new payment systems, getting ready for kind of open banking, that with your banking platforms. There's a whole lot of costs that are coming at you that relate to digitalization and modernization, regulation, and you're kind of thinking, as a smaller credit union, how do you survive in that, especially if the system entities that you would historically would have relied on, the centrals that would have helped you pool the spending and get the efficiencies, have been retreating a little bit. They've been stepping back, or at least are not working the same way they did 20, 30 years ago. So how in other words, could some of what we're seeing here be anticipating some of the merger activity that we've been seeing in the last few years? Is that maybe just anticipating this kind of change that's coming at us, rather than being motivated purely by a sense of kind of like, well, this is the research suggests that if we merge, we're going to grow. It's more about just staying alive in this kind of coming environment that we're staring down.
One of the things that I have touched on in the paper that I did not bring up during the presentation is the fact that what I fear, or I think is going to happen, is we will end up with few very large credit unions in every single province, okay, and they will hit the ceiling, and they will try to move towards the federal charter, and then the smaller credit unions and the entire system within the province may be in trouble as a result, and especially for smaller provinces where there aren't that many credit unions to start. Okay. As to whether we can generalize my studies finding for smaller credit unions, I'm unsure, but if I have to answer, I'd say no, because I think the smaller credit unions, and I have Luis here as well, and he knows also that the smaller credit unions has a very, very different dynamics. Okay, at least from US studies, that's what we know, because we have more detailed data, and they have a very different dynamics compared to the larger ones. If that is true in Canadian case or across the globe, which I think is the case, then this study is not really telling us very much about how those smaller credit unions are managing. Okay. And the things that you brought up, the digital platform, the security that comes with the digital platform, the having facilitating a customer who is going abroad with their payment, those are quite expensive. And smaller credit unions over time, I don't know whether they'll be able to afford.
Yeah. So again, I'll open it up for questions from the virtual floor. Either raise your hand or jump on, even jump on if you'd like, or use the chat function. Now, Mamun, one thing that I think I recall from your paper, there's a question, I'll go with that. Has there been any work done on inter-provincial mergers? This is from Wayne. Mamun, maybe you can speak to that.
When I do not think, and Marc-Andre, you can correct me, I do not think the Canadian regulators at this point allows inter-provincial merger. There is some data on US cross-border merger or cross-state merger, but not in Canada, no.
No, there have not been, but there is the opportunity with the federal credit union legislation.
Yes.
There is that opportunity. So there's something that could happen, but it hasn't yet, to my knowledge. The only thing that's sort of analogous to that is the centrals potentially merging. So we had Central One come out of the BC and Ontario centrals, and they effectively merged, but then there are some complications around that because of our provincial silos, you know. So yeah, it's I think that's more of a question from the US, but not so much relevant yet in Canada. Okay, Luis asks, are you looking at total growth or counting the target assets as growth, or at organic growth, comparing the assets of all parties before the merger versus post-merger assets?
So to Luis, so when there is a merger, there is a mechanical growth. Okay, and we all understand that. That's why if you looked at the one picture I showed you, okay, I calculate growth after the completion of merger. Okay, I do not calculate growth from the period before the merger, because let's say a $25 million asset value credit union merges with another $25 million value credit union. So um, if I so there is a mechanical growth already, okay, because their two assets are going to get combined. So I do not calculate growth from before merger. I calculate growth after the merger has completed. So I would like to see whether there is actually any addition, any growth after the merger has been finalized. Okay, and I still have additional issues because this entire merger announcement and the merger data is mostly hand collected. So I know when the merger has happened, but actually when it has completed, uh, in some cases I do not have confirmation. So I talked about 75 merger events. I had to throw out a lot of them just because I do not have confirmation as to what actually has happened when it finally completed.
Thank you, Mamun. We have another question here. This is from Annette. She's asking, are there any differences when the merging entities are similar in size or when the merging entities are different in size? So I think maybe for your merger analysis, do you observe anything there? Are you able to observe anything?
Okay, so when I say merger, I generally use merger as a broader definition. So a merger includes a merger. So generally the merger of equal is what you are talking about. It is also in the same definition, I'm including acquisitions. So when a much larger credit union is buying or acquiring a very small credit union, I'm also including in the same definition amalgamation when there are, let's say, 13 different credit unions are coming together to form one giant credit union. So all the three in my definition is a merger. Okay, I do not have sufficient data to segregate these three because if you look at my matching sample, I only have 30 or 40 data points. So if I start segregating it, I cannot do the analysis, at least not in a statistically valid way.
May I ask a follow-up, Mamun?
Yeah.
I know we have to be cautious about drawing from results outside of Canada, given the different regulatory and other environment. But do we know anything from other studies in the United States or elsewhere about the different outcomes from merger, or let's say mergers between rough equals, mergers between big and small? What is it? Do we see anything, any stories we can tell from that research, if there are any?
I have a study on the U.S. Credit union mergers, but I did not particularly look into that issue between the merger of equal and where there is one partner much larger than the other. So I cannot give you an answer from the top of my head. Luis Dupico out of Filene, he has looked into a bit more into the merger. So he may have a much more valid viewpoint in terms of US merger. In Europe, these mergers are few and far between to come. So it's mainly the US data set that will give us a much better answer to that question.
Right. Fair enough.
But I have not looked into that detail.
Sure. We do have another question here from Jordan. It might be interesting to look at risk outcomes. In other words, do mergers help reduce risk? And this, of course, could be helpful from a regulatory perspective. So I'm not sure if the data are available for that, Mamun, but could you potentially look at outcomes like delinquency rates, charge-off rates, failures, etc.?
For sure. And Jordan, I think you're right on the money. There are two things that I was thinking about, and this is one of them, because if we can show, there is a study, I completely forgot, based on US data, which shows us that if with the merger, if you look at the camel ratios, the camel ratio suggests that the risk is going down, at least using US samples. So it may very well be true for the Canadian sample as well, but I have not looked into that. But yeah, you are right on the money. There may be maybe other potential benefits that's not been captured. What I was trying to look at this study, I was trying to look at this study from a credit union's point of view, and that other study which looks into the risk looks at it from a system or a regulator's point of view, okay, as to why they have an interest in merging smaller credit unions with larger credit unions. Jordan, I hope I have answered your question.
So Mamun, one other thing, maybe sort of related, is and Jordan says thank you. So and I believe you mentioned this, if I'm remembering correctly now, when I read your paper a few months ago now. But you had there's some literature to suggest that at some point the economies of scale taper off, right? Like after a certain size, you don't get a whole lot of benefit from merging or getting bigger. But at the same time, it seems like in Canada, at least, all the incentives are pushing you to get big, right? We have 5 or 6 big banks that dominate the landscape. They get first cut at when federal government rolls out programs. They go to the big banks first. They don't go to the small players. I mean, the system seems to incentivize, never mind what the literature says, the system and policymakers seem to incentivize big. How do you reconcile, those two things and some of your findings, right, that are showing some benefit post-merger relative to those who don't merge? How do you reconcile the empirical finding that there's some limit of growth with what you're finding and with what I think you see from the policymakers who seem to want to grow growth at all costs, especially in the EU, but also Canada and elsewhere?
Well, this is what I say. Well, you are not a student, but this is what I say to my students, that generally the risk is proportional to your size. Okay, we have specified equation that shows us exactly why risk is proportional to size. So that means as you grow, your asset size grows, your risk is going to keep on growing. But the benefit is, if, let's say in Canadian context, if RBC gets into trouble, guess what will happen? The federal government is going to step in and bail it out. Okay. If a small credit union gets into trouble, probably they'll let them go. During the financial crisis, all the large banks that got into trouble, other than probably Bear Stearns, everybody got somehow bailed out. Okay, it's the smaller banks that failed during the last financial crisis. So the benefit of being large is, yes, you have growth, but there is this other literature which says you are becoming too big to fail. Okay, so there is this intangible benefit. Probably it's also a tangible benefit of growing.
Right, you're too big to fail, but you're also too big to ignore from a policymaker perspective. In other words, you get the first round of food at the buffet, at the government buffet. So yes, that's, I think, an important insight, and I think that's something the credit union system realized very tangibly in the crisis when the federal government rolled out programs that really landed at the banks first and then the credit unions second. Yeah, any other questions from Mamun here? Give folks another 10 seconds to throw your hat in the ring, or write your question or raise your hand using the chat function, or the raise hand function, sorry. Okay, well, Mamun, we're just about out of time anyway, so I think I might wrap it up and ask you, are you any last thoughts, Mamun, before we call it a day?
I think there is need for a lot more research. Okay, especially because how important credit unions are in Canadian context. I think outside Quebec, we have what, 5.8 million members. Inside Quebec, another 6, 7, 8 million members. So this is a very important sector for Canada. And I think there are more serious research needed here. But that also means that there should be willingness from the regulators to share the information. There should be willingness from the credit unions to share information, and or else this really cannot happen. With this bot data, we really cannot go very much. Okay, do very much.
Yeah. So I'll just second that. And I say as a former policymaker that that's abundantly true. I've seen briefing notes that were written on the basis of the thinnest of information, and big decisions get made that not always advantage credit unions on the basis of poor information. So I think, just to underline what you're saying, Mamun. So thank you so much, Mamun, for this presentation. Thank you for all the folks who joined in. The recording will be up before very long. We'll also share the paper around if people are interested in reading it. And please don't be shy to join our reading list, our mailer list, sorry. And we look forward to seeing you at a future event. I'll add finally in closing that the center has a pretty active credit union research program, actually. So I'd encourage you to stay tuned and watch this space for more. Thanks, everyone. Have a great rest of the week.